General Motors reporting a drop in profit in its last quarter despite higher sales, saying that tariffs cut more than $1 billion from its bottom line. And the company adding it expects tariffs to have an even greater impact on this current quarter results. Doug Flynn is here with more, co-founder, Flynn Zito Capital Management. Welcome, Doug. So you've had a lot of conversations about how the economy, companies, consumers have been withstanding or not being impacted by the tariffs, but GM says, no, they are having some effect. What do you say?
Well, they definitely are. And GM had chosen not to pass along the tariff increases to their pricing. So what that means is it has to come from somewhere, and where it's coming from is from their earnings and from their profit. And so that's why it got squeezed. That money went to tariffs. And so they have said that they're going to probably offset a good chunk of that, maybe as much as 30%, by onshoring, making more vehicles in the U.S., investing here. So that's a longer-term thing that happens. But they do, more than 50% of the vehicles that they sell in the U.S. are from overseas. So I think that's part of it. So it's a little bit of a shift. And they, look, they're probably going to at some point have to start raising some prices, but they're going to try to hold it as much as they can. And a lot of people aren't terribly concerned if GM's profit is, 1 billion instead of 2 billion. Eventually, though, they can only go so far before they have to pass some of that down, and I think that's what's coming.
Yeah, I mentioned that we were talking about how, in general, the economy has held up well. Like we talked yesterday about the domestic economy, and John Bussey, who works at the Journal, brought this up earlier, that the Journal had this big story about the global economy today. The headline was that the global economy is powering through this historic increase in tariffs. So that, a lot of uncertainty out there, but businesses and households have surprised economists with their ability to hedge. So people are figuring it out.
Definitely. I mean, they're adapting, they're adjusting, they're doing what needs to be done. And the interesting thing in here, I mean, you could see it in the stock markets, not just in the U.S. at all-time highs, but around the world. I mean, the international markets are even doing better than the U.S. markets this year. And so that's definitely happening. The consumer is still spending. And so when you look at global GDP, we always talk about GDP here, but if you look at the global GDP, year over year, it's about 2.4%. And through all of this tariff insanity, that's pretty much the long-term historical average of global GDP. So we're chugging along. People are adjusting and doing what they need to do. I don't know that 10% tariffs changes the world. I don't think I ever thought that. It's really the 30 and more percent that is going to have the impact. The 10% will adjust to. Some will get worked in. It's not going to change much, but maybe that brings a lot more revenue to the U.S. and maybe more onshoring, and I think that's the goal there.
All right. Now, you mentioned the stock market. Let's talk about the market here for the 90 seconds or so before the closing bell rings. Anytime you have a big run like this, people start bringing up the possibility that there's a bubble, right? There's the market up and down today, but as you say, hitting record highs. And Axios had this piece. It's never a good thing in the market when they say, oh, you're going to party like it's 1999, because we know what happened back then. By the way, that's when I started covering the market, and then the market quickly crashed after. I changed jobs, went to a second network in 2007, and then the economy collapsed in 2008. But I've been here safely enough for 2 years, Doug, so no worries. But I don't know. What would you say, though, about whether there's a bubble? Times are too good.
So I've been doing this, long enough to where I was here from 95 to 2000 when the NASDAQ went up fivefold. And then from early 2000 to the end of 2002, the NASDAQ lost more than 3/4 of its value, and then took 15 years to get all the way back. And so there's no doubt we are overvalued. We're probably more than 30% overvalued to the long-term historical norm. We're more than one standard deviation for the people that are into that. And so when you're valuing it, you could say, look, something's got to give. What we're hoping gives is that earnings rally, because they've downplayed earnings. And if earnings rally, then the PE ratios come back more in line. But if they don't, or tariffs take too much of a bite, or something happens, there's going to be further corrections, and they can be severe on the way down. And so look, this gets back to greed is kind of taking back over here out there, and I hear it in clients and what they're doing. And what you need to do is say, look, if I need my money in less than a year, it's at all-time highs. It's a great time to take profits and look to do that. And it's the 5-10-year money, not so worried, but that money that you need shorter term, you have to be really careful when things are this highly valued, even if they still do well over the near term.
Advice as always. Doug Flynn, thank you, sir. Closing bell time.